Ever feel like you need a secret decoder ring just to understand market newsletters and reports? You get stacks of charts, numbers, forecasts. But how do you quickly get to those essential aha moments? Well, you're in the right place. Today, we're doing a deep dive into a recent market newsletter. It's focused on the Indian stock market, and it's dated June 22nd, 2025. We've got everything from immediate market snapshots, key valuation parameters, and there's a fascinating long-term forecast using what's known as the Buffett indicator, plus historical trends, sector recommendations, the works.
Absolutely. And our mission here is really to extract the most important nuggets, the key insights from these sources. We want to help you understand not just what the numbers are saying, but, well, what they truly mean for the bigger picture, why they matter to you. We'll try to cut through all that data, give you a clear, concise understanding of where the market seems to stand and maybe where it might be headed.
Okay, great. Let's unpack this newsletter then, starting with the immediate stuff, the most recent data. The report gives us what they call Rvcc parameters for June 22nd, 2025, and compares them to the previous week. These basically bundle up valuation, momentum, sentiment indicators, like a quick health check.
Yeah, and what's crucial here isn't just that these indicators can shift quickly week to week, but how even sort of subtle movements can hint at underlying trends. So we see the price-to-earnings ratio, the PE, at 22.6. That's slightly up from 22.2 the week before. And the price-to-book, PV, is at 3.65, also up a bit, 3.6. This steady creep in valuation, even week over week, it suggests a market that's just getting incrementally more expensive.
Right. And the market cap to GDP ratio that's also edged up. It hit 121.71%, up from 119.81%. For our listeners, maybe just remind us, what does that specific metric tell us about the market's valuation relative to the whole economy?
Well, it's often called the Buffett indicator itself, actually. It basically signifies how much the total value of the stock market weighs against the country's economic output, the GDP. So a rising percentage, like we see here, indicates the market is, well, becoming more expensive relative to the economy's actual growth. It suggests it might be getting a bit ahead of itself.
Makes sense. Now, here's something that really jumps out. The Relative Strength Index, the RSI, it jumped to 65, up pretty significantly from 52.33. For people tracking market momentum, what's the key signal here? Does an RSI at 65 always mean a big correction is coming, or is it just strong momentum?
Well, an RSI at 65 certainly suggests that the market is moving into what's typically called overbought territory. It definitely indicates strong recent upward momentum. Now, it doesn't guarantee an immediate correction, not at all, but it's a signal to maybe exercise some cautious optimism. We also see a positive shift in foreign institutional investors' net open interest, the FEI figures. That moved to positive 14,929 from a negative 1,264. And that's quite a powerful indicator, potentially, of renewed positive sentiment and maybe inflows from foreign investors.
Okay. And the Nifty itself, the main index, moved up to 24,890.24 from 24,718.60. But then we get the most striking number, I think, the VIX, the volatility index. The report shows it's soaring, absolutely soaring, to 55.12. That's a massive leap from just 15.08 the week before. I mean, for any investor, that number practically screams brace for impact. It's almost like the market's having a sudden panic attack. What's your immediate read on what could be triggering this level of anxiety, and what are the implications of such a dramatic surge in volatility?
Yeah, that is truly a critical point for market sentiment. A VIX reading of 55.13, that indicates extreme fear or uncertainty in the market. It's far, far above its normal range. It signals significantly increased expected future volatility, so larger, more rapid price swings are anticipated. It's basically the market flashing a big warning sign about potential turbulence ahead.
Right. So we've just painted this picture of the market's immediate pulse, high valuations, maybe getting a bit stretched, and this soaring VIX suggesting extreme fear and turbulence. It kind of feels like a storm brewing. But then the newsletter zooms out. It applies the Buffett indicator for a long-term forecast. How do we reconcile this short-term volatility with what seems like a much calmer long-term outlook for the Indian market?
That's a crucial question, definitely. And looking at that broader context, the report presents two models, they call them original, and modified to forecast annual returns for the Indian stock market over the coming years. And interestingly, both models arrive at a remarkably consistent expected return, 6.3% per year.
Wow, 6.3%, and consistent across two models. That certainly sounds like a comforting long-term outlook, but, in a market that's just seen its volatility index explode like that, how much weight should investors really put on such a precise long-term number? And how is that 6.3% figure derived? What are the key components driving it?
Well, it's really about understanding the different time horizons, isn't it? The
Uh-huh.
original model attributes this 6.3% to three main factors. First, you've got 6.86% coming from economic growth, that's in local currency prices. Then 1.53% from dividend yield. And then, importantly, a negative 2.1% contribution from valuation reverting to the mean.
Ah, okay. So that negative bit means the model expects current high valuations to come down over time.
Exactly. It expects those current elevated valuations to sort of normalize over the long run, which slightly dampens the overall returns calculated from this starting point. And the modified model, it keeps the economic growth and dividend yield contributions the same. There's only a tiny shift in that valuation reversion component to connect at 2.11%. So it results in the exact same 6.3% overall annual return expectation. This consistency, across the models, it suggests a pretty robust underlying growth story for the Indian economy long term, despite these short-term fluctuations driven by sentiment, like that VIX spike.
Okay, that makes sense. So we've dissected the current numbers, we've peered into the long-term forecast. But for you, our listener, the real question is, okay, what do we do with this information? Beyond the raw data, what practical advice does the newsletter offer for investors right now?
Right. Well, the report suggests positive sentiments for starting new SIPs, systematic investment plans, and also STPs, systematic transfer plans. It basically advises that it's a good time to accumulate. This aligns with that disciplined long-term approach, capitalizing on market fluctuations by investing regularly rather than trying to perfectly time the market highs and lows.
Well, what about specific areas for investment, say, if we're looking out maybe 2 or 3 years?
For that kind of 2-3 year view, investing in business cycle funds is highlighted as potentially a good idea. The current fund focus mentioned also leans towards large cap funds and hybrid funds, so that suggests maybe a preference for a bit more stability or perhaps a blend of equity and debt.
Okay. And are there any specific sectors that the newsletter is recommending focusing on right now?
Yes, it's quite explicit. The current sector focus is on banking, finance, and defense. So this suggests these sectors are seen as having strong potential or maybe favorable conditions right now, perhaps due to policy support or specific growth catalysts, or maybe just a robust earnings outlook expected for them.
Interesting. Banking, finance, and defense. Got it. The report also gives us a really valuable historical perspective. It traces the Nifty's trend shifts over the last few years. It's almost like a vivid roadmap of how market sentiment pivots, in real time.
Exactly. The document lists significant Nifty trend changes going back to January 2022. And you see it oscillating negative, positive, neutral phases. What's really illuminating, I think, is how these shifts often seem to align with major global events or maybe domestic policy changes. For instance, it notes negative trends back in January 2022, then a positive turn in March 2022. That positive turn might have captured, some of that initial bounce back sentiment as the world was emerging from pandemic concerns. And then later, confirmation of negative markets in December 2022. Then a medium-term negative turn noted in August 2023, perhaps reflecting growing inflation concerns or global slowdown fears around that time.
Right, context is key. What are some of the more recent trend reversals noted in the newsletter? Anything from this year or last?
Yeah, it highlights April 2023 as the first time the market turned positive for equity after that negative phase in December 2022. Then, as I mentioned, that medium-term negative turn in August 2023, while interestingly noting that the long term remained positive throughout that period. More recently, a trend reversal, that's the term they use, was seen on March 21st, 2025. This was followed by a short-term bearish trend noted as of April 4th, 2025, which then, surprisingly, turned positive again after April 18th, 2025. It really shows the dynamic, often rapid shifting nature of market sentiment. It's often reacting very quickly to new information or perceived changes in outlook.
It certainly does, and the newsletter also specifically mentions the performance of the mid and small cap segments. What's the takeaway there, especially in the context of these broader Nifty trends we just discussed?
Well, interestingly, both the Nifty Small Cap 100 and the Nifty Mid Cap 150 indices are noted as remaining positive. So this indicates continued strength, or perhaps confidence, in these particular segments. Despite the broader market fluctuations, and even that dramatic VIX spike we talked about, it seems investors are maintaining their belief in the growth potential of these smaller companies.
Okay, interesting. So let's round out our deep dive now by looking at the specific sectorial index data provided for June 22nd, 2025. What did the latest numbers tell us about the different segments of the market, particularly on that specific day?
Right. And crucially, the data for June 22nd itself shows that many Nifty indices, including the Nifty 100, Nifty 200, Nifty 500, and various mid-cap and small-cap indices, actually recorded negative percentage changes for that single day. For instance, the Nifty 100 was down 1.3%, Nifty Midcap 50 down 1.59%, Nifty Small Cap 100 down 1.01%. So this suggests a pretty broad-based decline just on that specific date, June 22nd. And that might well have contributed to that extreme VIX reading we saw in the other section.
Ah, okay. We also see the PE, PB, and dividend yields listed across all these different indices. How do those ratios compare across the different market capitalization segments? What does that imply?
Yeah, if you look deeper at the data, you'll observe that the Nifty Midcap and Small Cap indices generally carry noticeably higher PE and PB ratios compared to the larger cap indices like the Nifty 100, 200, or 500. For example, the Nifty Midcap 50 has a PE of 39.29 and a PB of 5.56. That's much higher than the Nifty 100's PE of 22.41 and PB of 3.71. So this suggests that investors are, well, paying a premium for the higher growth potential that's typically associated with mid and small cap companies, even accepting those higher current valuations.
Right, that makes sense. Higher growth expectations baked in. Now, here's an interesting little anomaly, maybe. The Indy VIX is listed here again in the sectorial data section, but at 13.67, which is a huge difference from the 55.14 we discussed earlier, listed as an Rvcc parameter for the exact same date, June 22nd. What should our listeners make of these two vastly different VIX figures showing up in the same report?
That's a really excellent point to highlight. And honestly, it underscores the importance of, really understanding the context of any data point you see. These two different VIX values, 55.14 and 13.67, within the same newsletter for the same date, well, it could imply different calculation methodologies are being used. Or perhaps they're tracking different underlying instruments, maybe futures versus the spot index volatility, or it could even be different time frames being referenced for the volatility measurement somehow. Without more context from the newsletter source itself, it's hard to say for sure. But it definitely serves as a good reminder for all of us to critically examine the nuances of reported data and to always try and consider the source and the precise definition of each metric we encounter. Don't just take numbers at face value.
Absolutely. A bit of a data mystery there. Okay, so let's recap. We've unpacked the latest market parameters as of late June 2025. We looked at that consistent 6.3% long-term return forecast for the Indian market. We explored the strategic investment advice, SIPs, STP, focus funds. We traced the Nifty's sometimes choppy journey through recent history, and we just dived into the performance and valuations of various sectorial indices.
Yeah, the data really offers a rich tapestry of signals, doesn't it? You've got signs of extreme short-term volatility and slightly increasing valuations on one hand, but then you also have these clear long-term growth expectations embedded in the forecasts and specific sectors like banking, finance, defense, currently in focus. It's really about seeing the threads that connect these sometimes disparate pieces of information. Recognizing that short-term noise, like that VIX spike, often coexists with potentially strong long-term trends.
Well said. So, for you, our listener, here's a final provocative thought to maybe mull over as we wrap up. Given that dramatic shift in the VIX, signaling high anticipated volatility and maybe even fear in the short term, yet you also have this remarkably consistent long term return forecast of 6.3% for the Indian market. How do you personally reconcile these two seemingly contradictory signals? And thinking about your own approach, what might you consider for balancing those short term risks and potential turbulence with that more optimistic long term potential? Something to think about.